let's talk about this because this is one of the true differentiating pieces of options and futures. There you go. So, loss management. Let's talk about that a little bit from your side of the street.
Yeah, I mean, I'm really interested in this topic today because, I think you're kind of getting at it. I mean, it's different with futures and options in this regard. I mean, when I look at it from an option standpoint, it's you have situations of, let's say, a defined risk trade. You know exactly how much you can lose. And let's just say we don't typically do this a whole lot with but let's just say like a long put, to get back to something we've talked before. You know how much premium you paid for it. You know exactly how much you can lose, right? And so I think that's one of the main reasons why for years I know I was trading from the long side, and I know a lot of people do, because they feel like they have more control over the trade. You feel like you can close it out if you're losing XYZ amount if you choose to do so. Mm-hmm. And it's one way to look at it, right? And so if you have like in this case, we do have a short strangle, right? If you have a short strangle, to the downside you have to the upside you have unlimited risk, and to the downside you have risk to a certain point, right? To the idea of whatever it maybe goes to zero, whatever we're talking about. But you do have areas where you have to pay attention to, like. So I've always wondered like how. And I think that we're gonna get to that point. But when you're looking at it from a short strangle, it's interesting. You can make different adjustments, right? You can roll a put up and in that situation, and so you can have this inverted 65-60 strangle like we're talking about here. And then if it does stay within that range, you can eventually look to take a profit. So that's one way of managing that trade. But again, like we said, if you have like a long put trade, then that's more defined. And again, you can choose when you close out your position if you so choose. So, it is very different, like you said, when you're talking about options and futures. And this is kind of the option way that I've been more familiar with.
Right. And you know what? I think it's a great point is you talked about just one of the tools where you're still in that trade. And, I still don't do this really well with options on futures trades. I will certainly roll up a put, roll down a call. Going inverted, something the guys do nobody likes going inverted. It's a defensive measure, but they will do it because statistically it is one of the edges that is to be had in trading options. For me in the world of futures, it's like I'm wearing a full future. At that point, I'd rather have the full future. It's just, I think, from the fact of only trading options on futures for the last 5 years and trading futures for the last, oh my God, 40. That just sounds so.
I'm proud of you, man. You said it.
I can actually walk.
Well, say it.
I know I can walk with help. But the ability to work within that trade is very interesting. And I think what it lets you do is play. An inverted play is a defensive play. I think we both agree on that. Keeps you in the trade. It's a slightly different trade idea, but it is a defensive position that in some instances, best case, we're looking to get back to zero oftentimes. And that's not a bad, sometimes getting back to zero is a good thing. So let's jump ahead one, because we'll talk about the futures piece. And I think this is something you and I have talked about, but we can't reinforce enough, because now with options on futures, you're afforded a little bit more tools. But in the world of smalls, at least for right now, we've just got static delta futures. So management becomes it's not very different, but like the outcome almost, it's binary. So when you have just a future that has, when I say, we've talked about this before, a binary outcome. If you're short and it goes down, you win. If you're short and it goes up, you lose. That's about as straightforward as possible. Let's talk a little bit about the tools you had in the world of options and your thoughts about really where right now taking some of those tools away from you. Now, you had mentioned the idea of long puts and long calls. I think that splits the difference between selling premium and doing what we're doing here. Your thoughts on management of static delta futures. Where do you start thinking about that from the world you've come from?
Well, it's as soon as you pulled this up and as soon as you started talking, and while we looked at this before, it kind of really hit me as we're here. The most important thing on this slide is the fact that you have to accept the fact that trade defense isn't really there for futures. Yeah. You have to accept that. And I think that's the most important thing on this slide here. Once you accept that, then psychologically, how to deal with whatever may come, right? And that's the most important thing, because I think I started off talking about the idea of options. I laid out all the different ways of what you accept when you have a long option, what you may not necessarily do it. Right. Like if you're long puts and you're losing on it, you may not necessarily close out, but you always know that you can hit that eject button, right? You know right. that you can. If you're short that strangle, to the upside, you're unlimited, losses, and to the downside, it's, limited or to a degree to zero or whatever. Right. Those. And so you have to at least mentally prepare for those. And, I think that's the thing here. It would seem to me, you have to mentally prepare for the fact that there is no trade defense for it, right? Like, so that being the case, and you tell me what you think about this. I usually look at it from a standpoint of, I guess there's two ways that I could think about it, in this situation of small crude oil. So, I think we've talked about this before, the thing where you look at what we have laid out for the distribution of the moves over of a certain number of days. Like that's always kind of interesting and key to look, because it gives you an idea of how big of a move is actually happening currently versus, when I put this trade on or early in the week, et cetera. And then just your own personal idea of how much I want to potentially lose or gain. Right. So I think those are the two ways that I would look at it. You're so spot on. I couldn't have said it better, because the second piece, which is what you're comfortable with, if I hope I'm not boiling it down in the wrong way, but the comfortable win and loss aspect. We're all comfortable winning whatever, but it's what you're comfortable losing around. And that may be different. That is different for different people. And being comfortable around that loss amount will help you stay mechanical, stay disciplined, and stay in the game and be able to come back. And I think that's so important. Then you talk about, okay, we've got these binary outcome products. In other words, if they go up, we win. If they go down, we lose. It's a 50-50 world. How do we make it 51-49? Some of the biggest firms in the world, biggest market makers that I've worked with, are incredibly profitable, but they trade hundreds of millions of contracts, but they work on the 52-48. And that 2% is all the world to them in trading hundreds of millions of contracts every single day. So, when you think about that, anything we could do, and you mentioned, so statistics become a powerful tool for us. And like our weekly small exchange subscriber newsletter that our redheaded friend puts together and goes out every Monday to subscribers, and a light edition is available to those of you who aren't yet subscribers, but we hope you become subscribers. The full version's there, packed full of, and you summed it up, what's a normal day, what's not a normal day. And the hardest thing for me starting was, how do you determine that when you didn't have these statistics and it was more gut feeling? And a lot of times you didn't figure that out for a couple of days. You didn't make the adjustment. You were looking for either too small a move or too big a move, and you were getting run over until you kind of self-corrected, course corrected. So you're spot on. Let's use statistics to help us not only stay mechanical, and I think a good place to start is symmetrical. So in other words, I'm going to risk and lose the same amount. Now, is that always the case? Is it one for one? I've heard so many guys selling services. Unless you can make 3 times what you're going to lose on a trade, you should never do that trade. Now, I don't know how you grade that, before you put that trade on. And if you think about that from a statistical standpoint, that's next to impossible to achieve. Yeah, sounds good.
So I think, you want to start at that 1-to-1, and then you want to start deciding, as you mentioned, what tools can I do to move the ball from 50-50 to 51-49 to whatever, whether that be the normal, the standard, non-standard day that we look at in terms of statistics over a period of time, which is so powerful. What is it, what is in that 1 standard deviation, 2 standard deviation move? We know those are far more powerful than drawing a line on a chart. I think you and I both have been in business long enough. We could take this chart and draw, a line that shows that it's bearish and a cup and handle that shows there should be a break up to the outside. Anyone who has done any technical analysis can make anything look pretty much like it. And not to say that if it works for you, keep using it. Just be mindful of when you're looking at all these different tools, what you want to use. So I think here is the start, because if you just sat with that, as we did in our options example, we had a strangle on, we went inverted, we waited to a point where we could either get paid or get even, took that off. If we sat short here and we did nothing, we didn't go in with a game plan, either a symmetrical game plan that I'm willing to risk this to make that, or I just, as you said, it's wonderfully in the second part, what am I comfortable with? And don't worry about being comfortable. What am I comfortable winning? Be comfortable with what you're comfortable losing, because that is the great destructor of mechanics and discipline. Here, no management. You're looking at an $1,800 loss in a $6,000 or $5,000. Right now, a $7,500 futures contract. So, a huge amount of loss relative to the notional, let alone to what you're looking to make and lose on that normal day, that one standard deviation day. There's something called prospect theory. And also it talks about the pain of winning and losing, and also the aspect of when you lose 10%, and I forget what the number is, you're the scientist, you have to make back, it was either 12 or 14% to get back to zero. Yeah. So as you lose, the amount you have to, it's not like I can lose 10%, I make 10%, I'm back to zero. It doesn't work that way. So another case for mechanical, symmetrical start to your decision-making around here. And this is really something that I think we'll continue to talk about as we build out more and more trades and look for more and more trading opportunities. We have a strategy, and we've been talking about that. These are the right size products in terms of their size. They let us contemplate realistic management targets, which I mean are $50, $75, $100, instead of a day like today in crude where it was $2,000 from high to low in the institutional crude contract. So we're going to work on that a little bit, but symmetrical wins and losses go around that standard time frame. What else would you think about using to move that number from 50-50?
I'm probably the bad person to ask. I've still been using a little bit of the old ways, like you said, because more recently I traded oil a couple of weeks ago, and I was shorted at about 73 and a quarter, and then it went up to almost near 75 or so, and I just didn't feel it. It wasn't right, and so I actually closed it out for a loss because I just was like, I'm on the wrong side of this thing. At least I felt like it right now. Then it changed, of course. I think it was when we got to Wednesday and Thursday, we saw that decline in oil, and I was like, Of course, but it is what it is. I mean, I can handle that, and so I don't know if I'm the right person to ask, Pete.
I know. I think that was the perfect answer. You found a place where, you would, and I get asked so often, you sold the 73 and a halves. How could you buy them back at 75? That's higher price than where you sold them. Well, I was wrong. And the acceptance of being wrong a little less than half the time is part of trading static delta tools like futures successfully. So we're going to buy tops. We're going to sell bottoms, lows. It's the nature of what we do if we're going to manage our trades. But think about here is the opportunity, and also statistically, the larger your number of occurrences does two great things for you. It spreads out your P&L. In other words, the curve of winning and losing, and it also gives you the more you can trade with statistic advantage, the more likely you are to end up with a higher P&L at the end of whatever period of time you're looking at. Here, if you look at this and you were bearish at $55, if you managed, you would have been short a lot of times and been wrong, but you would have been short a couple of times and pulled some money out of this trade versus just being short forever. Because you know what? Until they get back to 55, I can never be long, and I'm not getting out till I get even. So, I mean, I think
that's a very good point, actually. I mean, because when you look, we're simplifying it on this chart, but the truth is there's plenty of opportunity within this chart for sure.
Right. And I think you make a great point here. And I like the fact that and I think that loss amount, whether it be the $1,400 or $1,500 you lost on your crude contract, or 140 or 150 on your smallest crude because it's a tenth the size.
Yep.
I always kind of call them walkaway losses. What I mean by that, nobody likes to lose money, but they don't plague my mind the next day. So I'm clear of thought that where if I'm used to losing $150, $200 and being around that $2,000 loser, if I have it, is going to haunt me and change and break my mechanics. So
yes,
you want to go back into that day, not unbiased. We all have biases, but it will help you maintain a little bit of unemotional aspect to your trading, which I think is an important aspect. So Jermal, great walkthrough here. Thank you so much. And I think, you hit on so many important points of how we take these products, we know all the benefits, but we also know the nature of what they can do without putting those mechanics together. So It was a great segment. Thanks so much.
For sure, my man. Appreciate it. I mean, I attribute those ideas to two things. And not that I'm certainly not frivolous with money, but I've definitely spent, $100 on dumber things than trying to trade oil. And, it's a motto around the house. I have to admit when I'm wrong. And I think you know exactly what I'm talking about. So.
Oh, man.
That's how I go. I apply these life lessons to trading as well.
You are an incredibly smart man. Well done by you. I love it. All right, guys. Well, we're going to wrap up this segment of The Leap with Jermal Chandler. Stay tuned. We'll be back with Frank Caberna and I in Splash in the Futures. See you back here in just a little bit.